to join me to discuss all of this is Alastair Newton, Senior Political Analyst at Nomura International. Alastair, welcome this morning. While they're talking about bank tax and regulation, we're actually seeing banks once again getting into trouble in Spain. How serious is this?
Well, the problem's a long-running one, of course. The Cajas were seriously exposed to Spanish property and housing loan. Nobody knows the exact extent of their non-performing loans. Let's be polite about it and call them that. But it is the Spanish equivalent of subprime to all intents and purposes. Now, to be fair to the Spanish government, they do have a contingency fund set to one side to bail these banks out, probably as much as 80 billion euros if necessary. We don't know if that's going to be enough. There needs to be a lot of consolidation in the sector. You can draw parallels between this and the Landesbanken in Germany, who of course have a substantial amount of subprime debt, probably also a substantial amount of Greek sovereign debt. And you know, we are going to need to see some serious consolidation in the banking sector in both of those countries, and there is going to be resistance from regional authorities. And in Spain, you know, we have to remember that the 17 regions are extremely powerful. They have a lot of autonomy. It's not going to be easy for the central government to push through necessary measures. You
talk about this being the equivalent to subprime. We're also seeing the LIBOR getting higher. Are there many parallels here with what happened in 2008?
I'd be really cautious about drawing too many parallels with 2008. I mean, if we look at markets this year, clearly we saw a recovery at the beginning of the year. Now we've got a great deal of concern about the risk of a sovereign default of some sort. But it's been very clear to me, we've taken this view at Nomura for some time now, that the risk of a sovereign default in the Eurozone is very, very low indeed. And that's certainly been reinforced by what we've seen in the last 3 or 4 weeks and the action which the Eurozone and the IMF have now taken jointly. Now, on the assumption that we're correct about that, I don't think we need to worry about another Lehman-type incident. That's not to say that we won't get some debt rescheduling downstream from, say, Greece. That wouldn't surprise me at all 2-3 years hence. But for the time being, the international community, that is to say the Eurozone and the IMF, are determined to hold the line where it is, simply because those risks which you talk about of a possible repetition of 2008 can't be dismissed entirely.
So is this the right time then to start looking at banking regulation, specifically levies on banks? I
would actually argue that it's probably too late in some respects. If I go back to the last major crisis we had in 1998, the ruble collapse, G7 at that time came up with a plan which is not all that dissimilar in its substance to what G20 proposed in London just over 12 months ago. And very little got done after that because the political momentum went out of the process. Now, clearly, what we've seen in Europe in the last few months with the Greek issue, what we've seen in the US around Goldman Sachs has added political momentum to the regulatory reform process. But the risk there is that Europe acting independently and the US acting independently will actually get ahead of the G20 process, which isn't due to wrap up until the Seoul summit in November. And that's going to run the risk of there not being an international agreement which is going to create a level playing field. Then we're getting into a regulatory arbitrage situation. And I certainly think that Tim Geithner today will be talking at some length with George Osborne, with Mervyn King and with Jean-Claude Trichet about the growing risk, as I see it, of regulatory arbitrage emerging even across the Atlantic, let alone in the wider G20.
Indeed, because if you look at this, the regulation is quite different. The regulation that's being proposed in the US and in Europe is quite different.
Absolutely.
One is protecting, the one in the US will protect investors. The one in Europe really won't. It's really about a fund that will help banks to wind down.
Yes, I mean, we need to be cautious about where exactly Europe's going to finish up on this. If we think about bank levies as an individual issue, what was clear when G20 finance ministers met in Washington in April is that for the Canadians, this is a red line. They are not going to sign up to a levy on their banks. They don't regard it as necessary. They still have an equivalent of Glass-Steagall in place. So reaching agreement in G20 is not going to be easy. Reaching agreement within Europe is not going to be easy either, because clearly George Osborne, for example, probably supported by Christine Lagarde, has a very different vision of how this levy should be used to the vision which Michel Barnier is setting out today. And here we get to a bigger issue, and that is the degree to which financial market regulatory reform, bank levies or whatever, is going to be controlled by the European Commission, and the degree to which it's going to be controlled by member states. Now, I think that's a battle the UK has to fight, and it has to play hardball on it. A pan-European regulator would be very badly looked upon by the City of London, and that's clearly where the Commission is trying to go. And this bank levy proposal they're going to put on the table today is another manifestation, and I say this without prejudice, I'm not a Eurosceptic, of the Commission looking to exert its authority and build trans-European power. And I think a lot of member states, not only the UK, are going to resist that.